What if I told you that the world's biggest money manager, BlackRock, with over $10 trillion under management, is staring down a 100% wipeout on a private loan? And that's right, they were wiped completely to zero overnight. And here's the shocking part, BlackRock didn't even see it coming. Now, this wasn't some rogue trader's bad bet or a fat finger. It's a screaming alarm that your safe investments are built on quicksand. Because just a month earlier, BlackRock said that this investment was 100% safe. Now, this BlackRock bombshell is going to be the first domino in a corporate debt apocalypse. It's about to torch jobs and send the stock market upside down. Now, stick with me because this nightmare that BlackRock missed, well, it's hiding right inside your investments. And I'm going to show you what you need to do right now to protect yourself before it's too late. Plus, tonight's show is brought to you by TNL Media Gene. You can find them on the NASDAQ in the symbol TNMG. And analysts had Benchmark are eyeing a price target of $3.50. That would represent an 1,100% move to the upside. And this is all backed by Asia's digital boom. It's fueling a revenue rocket for TNL that's blasting off. Now, this is one trade you don't want to miss. Stay tuned to the end of the show or check out the pinned comment or description for more information. So let's zoom in on this incident at BlackRock because it's got the financial world whispering in panic. Because if BlackRock missed this, well, what else are they not seeing? Because just a month ago, BlackRock was celebrating a $150 million private credit loan to Renovo Home Partners. Now, they're a home improvement outfit, and they've been scraping by as the housing market slows down. And at the time, BlackRock marked this loan as pristine, saying it was worth 100 cents on the dollar and locked it in as bulletproof. Then bam, last week, Renovo doesn't just trip and fall over. They hit the brakes by filing Chapter 11 bankruptcy, leaving lenders like BlackRock holding an empty bag. So all of a sudden, that golden loan, poof, a brutal 100% wipeout, forcing a full write-down. Now this begs the question, were these fair value marks that BlackRock assessed on this loan just smoke and mirrors to pretty up portfolios and pacify Wall Street? Because at Renovo, there was no cloak and dagger fraud, no cookbooks, no scandals even. What we saw here was capitalism failing amidst a slowing economy as the housing market continues to be saddled with too much inventory and not enough demand. So here's a reality check. There's $1.7 trillion in private credit right now. And where is it? It's in ETFs, mutual funds, pensions, and sitting on bank balance sheets. And right now, one borrower's failure can destroy billions of dollars overnight. And if you look at the timing right now, if you look at our economy, it couldn't be worse. Because what is one of the underlying issues? Liquidity is draining fast. And when you get bankruptcies, well, it goes away even quicker. And what this is setting up for is a massive credit freeze that's about to hit Main Street in a big way. Now, here's the proof. Let's take a look at this chart of the net percentage of domestic banks tightening standards for commercial industrial loans to firms of all sizes. Now, we don't have bankruptcy data, so we're going to look at the delinquency rate on consumer loans in red as a proxy. And you can see when the delinquency rate is rising, and remember, you get enough of those, they turn into defaults. What happens? Banks starting to tighten lending standards, which is why you see that blue line head higher. Because as bad loans pile up, remember, the banks are on the hook for them. So they don't just ease up, they slam the brakes. Because what they start to get afraid of is that there's another Renovo, or maybe there's a whole bunch of them on their balance sheet that they're missing. So the issue here, my friends, is this isn't a lone flare-up. No more than Tricolor was an isolated incident, or First Branch was a one-off event. This is another warning shot, because I'm going to show you exactly why more loans are about to go bad overnight, and a lot of lenders aren't even going to see it coming. Because the problem with Renovo is it didn't have enough new business to cover its expenses and debt. But again, this isn't an isolated case. It's happening all over the world. In fact, let's turn to China, because China's passenger car sales dropped 0.8% in October for the first time in more than a year as the gradual phasing out of local government trade-in programs add to the ongoing headwinds that are hurting demands. So what's happened? These companies, they borrowed billions of dollars on the promise of endless growth and stimulus. And just like Renovo was chasing housing dreams, what happened? It's all coming to a bust. And we talk about how you need more and more stimulus. Well, you can see why all of a sudden President Trump wanted to come out and say we could do 50-year home loans. Why we're talking about a $2,000 tariff rebate check. Because once you start having companies go Chapter 11 and their debt gets eviscerated, well, next thing you know, the entire financial system comes crumbling down. Now, beyond the end of those subsidies in China, the industry is still facing longer-term challenges from overcapacity and a longer-running price war that's squeezing automakers. Now, this overcapacity issue is not just a Chinese issue. You're seeing it manufacturers all over the world. Because what's happening in China is buyers, well, they're bunkering down. The economy's slowing down. And what do they not want to do? Is spend money because they're worried about their jobs. And that's exactly what Americans are saying right now. And what this is doing is it's leading showrooms sitting with brand new cars that nobody wants. So what we're facing right now is capacity around the world is too much for the demand we have. We're going to be facing rising unemployment and a lot more renovos. And here's the proof. Let's take a look at this chart of capacity utilization. That's shown in blue. Gives the unemployment rate in red. And you can see the near mirror relationship between the two. As less of a factory is utilized, well, you need a lot fewer employees. And that's, again, the risk that we're facing all over the world. Because, again, in Renovo's case, they didn't see a path forward. But a lot of companies, they're going to fight for survival. They're going to lay people off until they have no other options. But right now, it's not just the home improvement automobile sectors that are at risk. What we're facing is the entire transportation sector is about to take a huge hit. And a ton of jobs with it, and that means we're going to see a lot more bankruptcies in the future. As U.S. import volumes are projected to slow through the year-end holidays and into 2026, as tariff uncertainty weighs on cargo owners and the outlook for consumer spending remains clouded. Because right now, manufacturers, retailers, and other U.S. industries are completely dependent on their livelihood by bringing in goods from abroad. They're mostly absorbing higher import taxes, while small businesses in particular are struggling to manage supply networks without a clear picture of their landed costs. And for small businesses, this is particularly dangerous because many of them have borrowed heavily to cover the tariffs to bring imported goods in. And the problem is on those loans, they're paying astronomical high interest rates. We're talking 30%. The payment schedule, it's weekly. And that means they've got to be generating cash flow, they've got to sell goods, and they've got to do it fast. The problem is for them, if they don't sell through their inventory, on a best case scenario, they're just going to lay off. In a worst case scenario, they're going to be completely out of business and all of those loans are going to go to zero. And if the data is right, and I believe it is, imports and jobs are expected to take a huge plunge as the NRF and Hackett Associates port tracking data project to a soft finish to the year. If realized, this nearly 18% plunge forecast for December would be the slowest month since March of 2023. And along with that, jobs are going to go in a big way. Here's the proof. Let's take a look at this chart of imports and goods and services in blue against the unemployment rate in red. And you can see very clearly as imports decelerate, well, workers hit the unemployment line. And the risk we're facing right now, and all the evidence says, is that imports are going to contract and go negative. And what that's going to do is take the labor market with it. Because what you're finding out is the U.S. economy is completely dependent on imports to create jobs. And what this does is it adds fears. And this is what we're seeing in the University of Michigan Consumer Sentiment Survey. Because as you can see, when consumers lose confidence, buying conditions drop. And that's a big problem as we head into the holiday season. Because consumers are already saying, look, we're going to cut our spending. And what that means is for a lot of businesses that are sitting on massive amounts of inventory, well, they're going to have to cut their prices. And as they cut their prices, it's going to squeeze their margins even more. And that means they're going to be forced to lay off. And that's the risk here. And as evidence, the price pressures are coming down. U.S. consumer durables and personal goods inflation decelerated in October for the first time in 3 months. This reflecting a slight pickup in the degree of merchandise discounting, this from open brand price data. So what we're seeing is a sign of desperation by businesses because they're now starting to get worried that they're not going to be able to clear their inventory. And inventory eventually gets stale, new things come out. And if you don't move it, it becomes worth even less. Problem again, not only they borrowed against it, they had to pay tariffs to get it. And so what we're faced now is the magnitude of discounts edged up from the prior month to 20.4%, nearly matching the highest since July of last year. And the issue with this inventory, it's all been borrowed against. You know, we've been talking about these shadow lenders, and all across the supply chain, what do you see from the very beginning of manufacturing until it hits the retail shelf? Somebody's borrowing against this inventory. And the problem is, just like Renovo's debt went to zero overnight, we could see this happen to a lot more companies. And at the best case scenario, there's going to just be minor write-downs, and it's going to escalate to steep write-downs as the inventory doesn't move. And what is this going to do for lenders? Well, it's going to put them in the same position BlackRock's going to be on because they're going to be sitting on old, outdated products and no ability to sell them. And at that point, disinflation turns into outright deflation. So what we're facing is everybody's leveraged all across the supply chain. So what just happened with BlackRock's debt to Renovo going to zero, as you can see, is just the tip of the iceberg of what's to come. Now, BlackRock's Renovo implosion isn't just a blip. It's a flare gun. It's a warning sign on top of Tricolor and First Brands that there's going to be a massive corporate debt reckoning, where swaps and subsidies like banks who are trying to keep the debt alive can't outrun the fact that demand is plunging and credit cracks are getting wider by the day. Now keep an eye on consumer sentiment and sales trends, because if they continue to stay weak, and all the data says they're going to, then look for delinquencies and defaults to surge in the coming year. Now here's what you need to do right now. I want you to audit your portfolio for credit risk and look to rotate out now while you can, because if this thing goes up in flames, the doors are going to slam shut. And what I don't want you to do is get caught in the trap before it's too late. And something analysts are very bullish on, that is the stock for our sponsor of today's show, TNL Media Gene. You can find it on the NASDAQ under the symbol TNMG. Everything you need to know in the pinned comment and description below. Because a powerhouse out of Tokyo is lighting up the screens across Asia, as TNL Media Gene is your go-to squad for killer digital media, data smarts, and ads that hit home with millions of young tech-savvy fans. With 45 million unique visitors every month and 189 million digital views, they're already owning the conversion on news, tech, lifestyle, you name it. The crew's got the pulse on Asia's next big wave. And get this, their momentum is unreal. Last year, sales rocketed 35% to 48.5 million thanks to hotspots in media content, tech tools, and digital studios. Every part of the business is firing on all cylinders, pulling in more cash from ads, events, and smart data plays. Now fast forward to the first half of this year and boom, revenue jumped another 5.7% to 21.8 million. And they're setting up for a strong finish to the year as they're slashing their debt by 5 million and padding their cash pile. This isn't luck, it's smart plays that are paying off big time. Now here's the fresh fire. They're rolling out video ads on Grow Taiwan that's buzzing taxi signage network that's exploding from Japan straight into Taiwan streets. Plus, they're snagging a video pro from Business Insider Japan to amp up those eye-popping ads. And they're not stopping there. Free memberships surged 40%, paid ones up 15%, and they're gearing up to drop Business Insider Taiwan this year. Social followers hit 10.5 million. YouTube buzz doubled, and content sales skyrocketed 142% in Q2. Top analysts at Benchmark just dropped their latest note, spotlighting all these killer moves and sticking with their $3.50 target. And that's a shout out to the huge potential ahead as TNL Media Gene keeps stacking wins in this exploding market. Now zoom out. There's a whopping $61 billion opportunity here that's chasing Asia's billion-strong millennials and Gen Z who crave luxury and live online. And analysts are pumped, eyeing huge upside as they chase that 50% slice of global consumer growth. Wrapping up with revenue climbing, cost in check, and fresh wins stacking up, TNL Media Gene's primed for a ride of their lives. And the second half's looking loaded, and that Asian digital surge, it's just getting started. Keep an eye on TNL Media Gene. Again, you can find them on the NASDAQ under the symbol TNMG. And as always, with any company we feature on the show, you're under no obligation to purchase their stock. Be sure to do research before placing any trades and use your risk control levels when you do. And with that, I'm Steve Van Meter. Thanks for watching. Thanks for being fans. Bye now.